Hi, this is Professor Karen Lin. In this video, I will continue the discussion of FIFO, LIFO, and average and show you how to calculate these three different methods using an example. We'll be using this daily harvesting example to talk about these three different methods. Let's get started. Alright, so now let's take a look at an example. Assume that Harley-Davidson dealer has the following inventory transactions. At the beginning, there is an inventory of 2 units of leather jackets, and each unit is worth $70 each. Now, that is the cost of the purchase. So when Harley-Davidson got the leather jacket, they got it for $70 each. January the 12th, they purchased 4 more units of the leather jackets at $80 each. Okay, so if I calculate the beginning inventory, $70, 2 pieces, that's $140. The purchase January the 12th, $80 each, 4 pieces, and then $320 in total, right? In the 14th, they purchased another unit, and it's $100 each, so it's in total $100. You will see all these inventories we have at the beginning plus the purchases would equal to something called available for sale. If I add them up, that's $560. It also says that January 15th, Harley-Davidson sold 4 pieces of the leather jacket for $120 each. Now, pay attention. What we talked about before are all referring to the cost. Now, when they sold their leather jacket for $120, these are not costs. These are sales revenue. So when you sold the jacket, let's assume credit sales, you would debit accounts receivable, $120 each multiplied by 4 pieces, that's $480, right? You debit accounts receivable, you credit sales for $480. If you don't remember this, go back to basically chapter 6. Or even earlier when we talk about revenue recognition. Okay, so we know that sales equals to $480, but what is the cost of goods sold when they sold these 4 pieces of the leather jackets? Now you have to make an assumption, okay? So you know you've sold 4 pieces of the jackets and you got $480 from your customer, but what is the real cost to that $480? The cost of goods sold depends on the assumption either FIFO, LIFO, or average. That's what we are going to talk about in the next couple minutes. The first example we are going to illustrate is first in, first out. From a first in, first out perspective, the 4 units that we are selling on January the 15th would be the 4 units that comes into the company the first, which would be the beginning balance of the 2 pieces worth the $70 and another 2 pieces purchased on January the 12th. So we take the beginning balance, we exhaust the first batch of the inventory, and then we move on to the next batch and take the 2 units out of the 4 from the second batch. So formally you use 2 multiplied by 70 plus 2 multiplied by 80, that equals to the 4 units you're selling and gives you the cost. So visually, it's the 70, 70, 80, 80 added up to be 300, right? If I'm using the formula that I just talked about, available for sale can only go 2 ways. It either goes to the cost of goods sold or goes to the ending inventory. So I'm going to take the $300 ending inventory, subtracting from the cost, from the available for sale, I get the ending inventory. Or the other way around. If I say, okay, if I use first in, first out, what's left in my bucket would be the 2 pieces worth 80 each and the 100, added up to be 260. So I know available for sale 560, I know ending inventory 260, subtracting 260 from 560, we know cost of goods sold would be 300. Now pay attention, okay? Pay attention that no matter, regardless of which one you're calculating first, you can calculate cost of goods sold first, subtracting from available for sale, you got the ending inventory, or the other way around. You can calculate ending inventory first and reach the cost of goods sold. Now, either way, you should get the same number unless when you calculate, some of the numbers are subject to rounding. If rounding is involved, it matters from a very small decimal point perspective. It matters which number you calculate the first, because that would affect the other number. So pay attention in your homework. The textbook may ask you to calculate the ending inventory first, and then to get to the cost of goods sold. If that is the case, you need to follow the instruction, okay? Because if rounding involved, which number you calculate first matters. All right, LIFO. LIFO says that we are selling the last batches of the inventory and then move to the first batches. So if I'm going back to this description, the 4 units of leather jacket I'm selling on January the 15th should first come out of this $100 jacket, right? One piece will be coming out from here. So one piece should come out of the 100. And then 3 pieces should coming out from this 4 units. So we take 3 from here, which equal, each one is worth $80. So you take 1 from the last one, and then you move on to the earlier batches and take the rest from the earlier inventory. So visually, you will see that what's remaining in the bucket, if last in first out is used, would be the earliest inventory that we obtain, which means we are selling the latest inventory first. So using the formula, if we look at what's in the bucket, that's the $270 piece and the $180 piece added up to be $220. So cost of goods sold would be $340. Okay, so that is how you calculate using last in first out. Now average cost method assumes that the costs are moving on the moving average, which means how do we know the average cost of the 4 units that we are selling on January the 15th? What is the average cost of the available for sale? That's the idea. So how we are going to calculate the weighted average is the following. We are going to take the available for sale, okay, which is $560 available for sale, divided by available for sale units, right? How many units do we have available for sale? It's 2 units at the beginning plus the purchase 4 and then plus the purchase 1. If you add these 3 batches of inventory up, that's 7 units that's available for sale. So in my available for sale, in my bucket, I have $560 worth of goods, and there are 7 units, so each unit is worth $80. So I assume that the 4 units that I'm selling has an average cost of $80, so the cost of goods sold would be $320, and ending inventory would be $240, because they should add up to be $560. That is average. Now let's compare the results, right? What's the difference between these 3 different methods to our accounting? So the difference is the following. If you look at the trend of this transaction, you will see that the inventory costs are going up. You will see at the beginning it's worth $70 and then $80 and then $100. So this is very similar to reality, because reality is almost always in an inflation case, right? So basically that would make our sales number different. In an inflation world, which is this example, LIFO would produce the highest cost of goods sold, okay? Because LIFO assumes selling the latest inventory. In an inflation world, the latest inventory are more expensive than the earlier inventory because price keeps going up. If you assume you're selling the latest inventory, your cost of goods sold would definitely be higher than if you're assuming selling the earliest inventory, right? If you're selling the earliest inventory, the cost would be lower. So in an inflation world, LIFO produces a higher cost of goods sold than FIFO. Now, when your cost is higher, the gross profit is lower. When gross profit is lower, income before taxes would be lower. And then your income tax would be lower. Okay? So what's the good things about lower income tax? It basically means that you save some cash because when you pay for IRS for the tax, you pay cash. So if I could save some cash today, I could invest those cash in some other projects that makes me some more profits. If we are using average cost, you will see the cost of goods sold is basically between the two, of course, because it takes the average of the cheaper and the more expensive inventories. So average cost method produced the median, basically, case of cost of goods sold between FIFO and LIFO. Okay. So this costing comparison is not the emphasis of our chapter or our material, and it's not being you are not being tested on this. The idea is that I want you to understand if accountants use different costing methods, there will be different consequences in terms of their income taxes or their net income. All right, you should watch the McGraw-Hill Guided Help video 7-2, which will discuss the costing methods and the example. I'll see you in the next chapter.